Good morning, everyone. This is me, CA Vandana from Research and Advisory Division of Texman Group of Companies. Hope you all are doing well and your loved ones are healthy and safe. I would like to extend a very warm welcome to all of our participants in Texman's webinar organized on NFRA audit quality review reports, key observations made by the NFRA in the reports issued by them. This session has been basically organized by Texman. So before moving on to next, let me just give you a brief intro about the Texman group of companies. So guys, Texman is a leading publisher on income tax and corporate laws in India. We maintain the largest and the most accurate database on income tax, international taxation, GST, company and SABI law matters, accounts and audit matters, and Indian acts. Our products include books, journals, online and offline research platforms, and tools for tedious compliances as well. Moving on to next, here we have some of the tips for attendance. So guys, your mic will be on mute and you will not be able to communicate during the entire session. And however, you may post all of your questions in the chat box window, which is given right there on your right hand side. All of your questions will be answered by our eminent speaker either during the session or after the session itself. And once we all are done with this session, then you all will get a copy of this presentation for your future references. So guys, as we all know that nowadays the NFRA has issued this audit quality review report of the ILNFS for the statutory audit. So basically, apart from that, the reviews and the comments which the NFRA has issued, it has questioned over the independence and the objectivity over the, I think, the auditors and the practitioners regarding the quality of the engagements which are being performed these days by the auditors or the CA members in practicing. So basically, we would like to cover up all these things, like what are the major concerns that NFRA has been addressing these days. So basically, I'll give you just a quick brief about the NFRA. So the National Financial Reporting Authority is a body constituted under the provisions of the Section 132 of the Companies Act 2013. And this constitution has been effective since 1st October 2018. And, this has been inactive after our nation has, addressed various recent scams like the PNB scam and other financial scams and frauds in the country. And apart from after that, this NFRA is a very welcoming move, like which can actually improve the investors and the public confidence in the financial reporting of an entity. And the NFRA has been ensured and has been granted such power to investigate and conduct the quality reviews for a certain prescribed classes of companies. The NFRA also holds the power of investigation of a certain class of bodies, body corporates, or persons in relation to matters of the professional or other misconduct. So, for a detailed part of this session, I would like to hand over this mic to our eminent speaker of the day, who would be concluding the session and providing you a deep, detailed guidance over the working of NFRA and the major concerns like its independence and the concerns which have been raised. So basically, let's welcome our speaker, CAD Ramprasad ji. He's a practicing chartered accountant with 30 years of experience in both corporate and assurance and consulting roles. He has a good experience in our core assurance domain, due diligence, mergers and acquisitions, besides handling the treasury function during his corporate tenure. So, sir, it's over to you. Please take a lead over the presentation.
Thank you, Vandana. Good morning to all my friends who are participating in this session. I thank you for your valuable time. I'm also thankful to Taxman for this opportunity which is given to me. And very elaborate introduction has been given about NFRA and its role. And I would like to start this session by giving a disclaimer that this whole presentation is based on the actual findings as per the NFRA report. And this is neither an independent view nor the opinion of myself or the firm I represent. Neither is any opinion expressed for or against or any audit firm or NFRA. So with this small background and introduction, let me move on to the next slide. I think Vandana has already elaborated what NFRA stands for and what is the regulator's objective. And I'd like to just highlight item number B there, which is in bold. Monitor, enforce compliance with accounting standards and auditing standards in such a manner that, as Vandanaji rightly mentioned, that it enhances the stakeholders' confidence in the reports issued by the practitioners. The typical review of NEFRA would include a review of working papers, communications related to audit, the sufficiency of the quality control system of the auditor and the manner of documentation, and perform supervisory and control quality control procedures as may be necessary or appropriate under circumstances. So this is typically the background and the backdrop of NEFRA and its ambit of scope. Moving on to the process, I would like to say that the observations of NEFRA in the audit quality report are restricted and related to certain significant deficiencies and does not cover all deficiencies that have occurred in the performance of the engagement by the audit firm. And typically NEFRA commences the quality review engagement, issues us something called the prima facie conclusions, to which an audit firm has to give the reply, followed by the draft audit quality review report, which in turn the responses from the firms are considered appropriately, and then the final AQRR report is being issued by the NEFRA authority. Yeah. So please understand and note that AQRR is not an overall rating tool of any audit firm, and therefore it is just a factual finding report and nothing more than that. Yeah. The key observations from NEFRA relates, with the non-compliance with independence requirements as per NEFRA. Two of the important concepts that we practitioners keep in mind and which we always follow is independence of mind, which is nothing but a state of mind that permits the provision of opinion without being affected or prejudiced or any compromise of professional judgment, which prohibits an individual not to act with objectivity and professional skepticism. Independence of mind. Independence in appearance would mean avoidance of facts and the circumstances that are significant, that a reasonably well-informed third party having knowledge of all relevant facts, including safeguards applied, would reasonably conclude a firm or a members are of the assurance team's integrity, objectivity, or skepticism has been compromised. So we talk of two independences here: independence of mind and independence in appearance. Both have to be maintained, is what the view of NEFRA is. And moving on to the next slide. What is the compliance with the independence requirements? 144(8) of the Companies Act very clearly auditor is expected not to render certain services, which inter alia includes accounting and bookkeeping services, internal audit, design, implementation of any information system, actuarial services, and I would specifically bring attention to the word management services and any other kind of services that may be prescribed. So if at all you are rendering 1 year before the date of commencement, you should ensure that you are out of those services. Compliance with independent requirements, provision of management services leading to self-review threat. So admittedly, the term management services has not been defined in the Companies Act. In such situations, the settled principles of statutory construction require that the words used in statute must be understood in the normal or dictionary sense and being given that literal and direct meaning. I would put this management services are understood to mean services that essentially constitute management responsibilities, including providing any support by way of analysis, research, advice that is required by the management for performance of those functions and actions. Example, Ind AS implementation services provided by way of advice or review on conversion of consolidated financial statements, which could lead to self-review threat. This is one of the observations. And what are those observations? We'll just go and see. Threat to independence requirements, the provision of Ind AS services, inter alia could mean, in NEFRA's view, the below points are considered as management services. Discussion with management on accounting policy options available under Ind AS and their implications, including providing insight on Ind AS, providing Ind AS technical material and guidance of general nature, advice to management in understanding available accounting options under Ind AS. Threat to independence requirements, advise, review, and provide observations on technical accounting memoranda prepared by management and proposed accounting policies. Advise, review, provide observations on calculations of specific adjustments for conversion from local GAAP to Ind AS, comment on skeleton Ind AS financial statements, and comment on disclosures as prepared by the management could all lead to a threat to independence requirements. The other observation was on going concern, and all of us are aware what going concern is. We'll start with saying that all accounts, financial statements, the fundamental assumption would be the going concern assumption, and it's bounden duty of the auditor to obtain sufficient and appropriate audit evidence regarding going concern assumption and conclude on the appropriateness of the management's use of going concern assumption, and to evaluate events or conditions that exist and that can be assessed as material uncertainty on the going concern assumption, and essay and sufficient appropriate audit should be obtained for the same. Some indications that may cast doubt in the going concern assumption inter alia could include long-term borrowings, negative cash flows, adverse ratios, lowering of credit rating, loss of key in manpower, etc. And as is the want, if you get into the auditing standard on going concern, this list which I mentioned above is only an indicative list. There are so many other indicators which are given in the detailed standard auditing standard on going concern. If you see going concern, their comments inter alia include cash flow, where they say there's an absence of projected cash flow for next 12 months from the date of financial statements and no linkage to any work papers. But such cash flow statement has been attached as a file in the going concern memo, and there are no detailed notes and evaluation. Similarly, a copy of the credit rating agency report is not available in the file, and neither the implication of such rating has been assessed and analyzed. The GC memo has been signed a day before the audit report, and what is extent of work done remains a key question as per them, and no linkage between the GC memo notes to accounts, and general remarks in the going concern memo, and no specific reference to management memo, and no pointed discussions on key going concern considerations on finance related aspects, including those which charge with governance. Others on going concern matters inter alia include failure to test the source of cash generation and the company's ability to meet future liabilities, the final assessment of GC memo and conclusion not adequately documented in the work papers, documents in work paper files contradicts audit team's conclusion, and another important point, futuristic statements on projects or contracts have not been corroborated with any external evidence or papers, and hence full reliance has been placed on management representation without independent verification of such management representations. So these are the other points that have been made in the NEFRA report. I'd like to clarify here that this presentation contains all the points from all the reports so far issued. Wherever repetition has been there in all the reports, I've avoided them, but I have essentially brought out every single aspect, more or less all the key observations from all reports. Moving on to the next slide, evaluation of risk of material misstatements. The key observations are as under. The team planning events neither discussed the fraud risk nor fraud considerations memo, and also failed to analyze frauds in significant accounting components and how eventually they are addressed in the audit process. Robustness was not noted in the team planning event on revenue recognition, and the presumption of fraud risk in revenue not discussed. The most important aspect of management override of controls and its implications and the response of the audit firm are not evidenced. Similarly, components susceptible to risk of material misstatements in entities' financial statements due to fraud and the response of the audit firm have not been adequately documented. On the investments side, Ind AS non-compliance is noted as per NEFRA. According to them, associates have to be tested for impairment have not been tested, although the indicators are available. There was no evidence in the audit files. Similarly, an emphasis of matter of associate company has been reproduced, and no separate assessment has been done by the firm as required under Ind AS, and no adequate work done and assessed at the holding company level. In respect of management-related representations, it mentions that complete reliance has been placed on management representations regarding carrying value of investments in associates. Estimates which are given in independent legal opinion have not been corroborated or verified. Similarly, no independent evaluation of management's experts' work used as audit evidence, and no independent evaluation of management's review and approval process and testing of data on the internal control of our financial reporting related to investments. And finally, concluding that the recoverable amount has not been computed and not addressed by the audit firm in the last point. Yeah. Similarly, in respect of the reversal of ECL, which is a significant component in any financial statement under Ind AS, the evidence of ECL models having been independently verified by the audit team is not evidenced. Similarly, the computation of the deemed cost of investment assessment of the same is not available, and no sufficient appropriate audit evidence for reversal of ECL by way of notes, analysis, and justification is there in the audit file at this point in time. The reversal of expected credit loss. The documents which are not available in the audit file entirely include reassessment of business plans. How does one evidence the risk of reduction in credit risk? What is the evidence supporting the same? What is the evidence of increased cash flows which allow the management to reverse the ECL? Similarly, when an evidence for credit impairment is observed and such credit impairment risk has been ignored, these include conversion of loan which was having an interest bearing component to 0%, conversion of loan to equity in the documents, and increased cost of projects, which all lead to evidence for credit impairment. However, the same has not been adequately documented in the file, is what the observation given by NEFRA in their report. The other key observations by NEFRA include derecognition of loans, a reversal of ECL, accounting of deemed equity not backed by SAE, and the last point, no qualitative or quantitative disclosures as per applicable standards have been evidenced in the audit file. In respect of provision of interest-free loans to joint ventures and subsidiaries, the management expert's opinion of JV received and filed one day before signing of audit report, and the extent of work which is done is on the same management expert's opinion, including assessment, was not readily available. No independent evaluation of reasonableness and relevance of assumptions of management expert. Similarly, in respect of loans which were made available, no sufficient testing or granting of loan found in work papers, including detailed assessment of the ability to repay the loan. And finally, the conclusion, that the opinion and conclusion as the same, and the conclusion of same was not evident in the work paper file. In respect of financial guarantees, the key observation by NEFRA include letters of comfort, and I should also add letter of awareness, are not treated as financial guarantees, but disclosed in the financial statements being challenged by NEFRA. The concept of substance or form in documentation not followed consistently, and letter of comfort for SPVs which were not performing well or not available in audit files has also detailed work in respect of such a letter of comfort in respect of such SPVs were not available. In respect of derecognition of borrowings, the the bank confirmations not available to evidence the appropriateness of the derecognition of such borrowings. There was no deed of assignment of loan found in work papers, and principles of accounting standard inter alia related to derecognition of borrowings not followed. And finally, the appropriateness of derecognition is being challenged by NEFRA. Key observations by NEFRA in respect of evaluation of engagement quality control EQC review. There was no evidence of discussion of critical matters between the engagement partner and the engagement quality control review partner. No comments or inputs of the EQCR partner noted in the planning event. And finally, taking a yes/no checklist and signing on work papers. NEFRA believes that it is not sufficient evidence to prove that EQCR has done an objective review and evaluation of significant judgments made by the engagement partner. On the matter of evaluation of communication with those charged with governance, which entirely includes the senior management of the company, the CEO, the CFO, and the board, and the independent audit committee. Key observations by NFRA is opinion on going concern formed based on meeting with those charged with governance, and same was not supported by appropriate records, including cash flow projections and the analysis thereof. No evidence of significant matters, including audit plan, have been communicated to those charged with governance in a timely manner, and that includes risk of material misstatement as given by the earlier slides which I mentioned. Yeah. In respect of Coro related matters, the key observations by NEFRA include the evidence of stock statements which are available in files, and there was no physical verification work papers are available. What the files had was only the stock statements which were filed. There was no separate section available on physical verification exercise carried out and the evidence of the same. Similarly, in respect of checking of internal controls related to inventory and cutoff procedures, evidences were not available. So to the last, what are those documents which evidence those procedures? Similarly, no evidence of reconciliation book records and physical verification papers available in the file. In respect of litigation related matters, NEFRA had some key observations. EOM emphasizes a matter given in lieu of qualification regarding investment in a company. If the company continued to show shares as current investments when a portion of same has been sold by the lender in the market, and the matter, in the opinion of NFRA, should have been qualified instead of being shown as EOM, as there is a ownership issue relating to those shares. Similarly, there is a judgmental matter in respect of recoverability of trade receivable, and the same not backed by sufficient appropriate audit evidence. And ideally, according to NFRA, in case there is a disagreement, it should be qualified in audit report and not to be reported as an emphasis of matter. Yet another point made by them includes no updated legal opinion, stroke detailed analysis of such a legal position and litigation was available in the file for an emphasis of matter on a matter concerning an arbitration before the Competition Commission of India. So these were the key observations by NFRA, which was related to litigation related issues. Uh, Observations related to other documents and evidences as given by NFRA include an auditor should have evidence in file on why a qualification was not necessary in respect of a matter which is litigated and why he believes an EOM is sufficient. Similarly, in respect of shares which were held in demat form, there was no independent confirmation, third-party confirmation, which was available in the files. Similarly, in respect of certain key important documents like contract notes with customers, sorry about the spelling mistake there, claim documents, arbitration award, appeal filed, and minutes of meetings with clients department, not available in the work papers file of the engagement team. This I would like to spend some time on this evaluation of internal control over financial reporting. The list of questions used for evaluating ICFR for purchases, sales, etc. is by way of checklist with column for answers as yes and no, which is something NEFRA has mentioned. There was no documentation of work done pertaining to risk associated with the businesses, various operations of the company, and the company's strategy to minimize such risks. So in their view, business risk and operations risk and the control surrounding the same were not documented. And what was the company's strategy to minimize them were not documented, and no work was performed on such areas. The work paper contains only trial balance, some bank guarantee copies, some statement of contract receipts, and these were attached as as part and parcel of the audit work papers. However, there was no documentation of audit procedures which were performed on these aspects, and how the conclusions were reached were not evidenced. The last point of observation made by NFRA includes IT processes which are relevant to flow of transactions in respect of every single operation aspect of the company, like revenue, purchases, other costs, other expenses, borrowings, debtors, payables, etc., have not been identified by the audit firm for testing operating effectiveness of IT controls. So those are the key observations they made on with relate to ICFR related matters. To supplement the same evidences on the evidence part of ICFR, there was no evidence in the file for risk control matrices, which includes description of the process, the risk associated with it, the key controls which mitigate those risks, the frequency of such controls, the other operation aspects, the design part of it, the operating effectiveness part of it, and how the same has been tested. What is the conclusion which has been which has been reached by the management, the various process walkthroughs, including a diagrammatic and schematic representation of same, the detailed notes surrounding the processes, and the various controls which were tested. There was no evidence in the files regarding the same. Similarly, in respect of evidence for impairment testing for investment in associates, the indicators of such impairment were available in the associates company. However, there was no testing of such impairment indicators. There's no work done, and neither conclusions reached have been documented. And the last point is in respect of certain litigations, particularly with respect to tax-related matters which were under litigation. There was no evidence of any updated legal opinion which have been obtained, nor work done on the same, nor any conclusions reached have been independently filed in the audit work papers. The evaluation of ICFR, the key observations on NEFRA. EOM was provided on matters where external confirmations were not obtained on receivables, loans, bank borrowings, since the matter was regarded as sub judice. There was no detailed observation in the file as to why an EOM was necessary in view of qualification, and how did the audit team come to that conclusion. Was not available. Similarly, investments made in an associate were not written down to nil value despite lenders invoking pledge shares of the concerned company, and there was no sufficient appropriate audit evidence for considering the same as investment. No detailed analysis in either work paper was available, as also an evidence of the matter having been raised with those charged with governance could be found in the files. These are the observations given by NFRA. In respect of revenue recognition, the key observations by NFRA inter alia include the fact that the work papers had trial balances, they had bank statements, salary sheets, and subcontract expenses. There are no other papers to corroborate the revenue recognized in the books, and there was no evidence regarding the conclusion as regards the appropriateness and accuracy of such revenue recognition, including tailored audit programs and steps performed to finally conclude the appropriateness of such revenue and accuracy of such revenue was not available in the file based on observation given by NFRA. Similarly, NFRA also observes that there was no record of independent engineer's report where on matters concerning technical estimates, completion on the percentage of completion, etc., verification of contract, the verification of subcontract agreements, summary notes regarding the same, an independent engineer's report, determination of POC, and various cost sheets and with respect to various projects. There was no record of these important documents, neither summary of the same nor evidence of work performed by the audit team. On the regulatory related aspects which are given by NFRA, there were a lot of regulatory reports. One of it specifically mentions Reserve Bank of India. Such a regulatory report on the company which were being audited by the firm was not considered by the firm, and lapses noted in such report were not communicated with those charged with governance and was not followed up in the audit process. Then another observation they make is that the lapses in such regulator's report have not also been factored in the assessment of risk of material misstatement. Similarly, critical agreements and the summary of the same, like shareholder and options agreement, are not part of audit files, and there was no evidence regarding checking and verification of the same by the auditors. Yet another regulatory related observation by NFRA includes loans given which were not secured, and no registration of charges was created, and the same was not properly evidenced, and the sample selection according to NFRA was not adequate considering the significant amounts and the fact that they were low in number in terms of the quantity, but they were significantly high in terms of value. Some more regulatory related observations, key observations by NFRA include charges which were pending for registration for more than 1 year for loans have not been factored in the audit process, and the same was not verified. This is in respect of borrowings and charges were pending for registration for more than 1 year. Similarly, subsequent events like a decline in share price of a company have not been factored in the audit procedures. No further analysis was done, but the fact was of the same was mentioned only as a passing reference in the audit file. Similarly, yet another regulatory action, including show cause notice for cancellation of registration with respect to RBA, was not appropriately factored in the audit procedures and ignored, is what the comment made by NFRA. So these are the key observations which on a broad reading of the reports which have been issued by NFRA, I could summarize and give them. And I thought it appropriate that whilst the key observations of NFRA have been discussed, the mandated dues, which probably is an indicative list, which is nothing but what is governing us by the auditing standards, should also be discussed. And I thought it is appropriate to spend some time on it to address the key observations as given by NFRA. So let me share some of the key mandated dues. And this again at a very high level. Obviously, the standards are by themselves very vast and extremely detailed. The standards on auditing issued by the Institute simply follow the international standards of auditing. And hence, what I have done is to give an indicative list and at a very, very high level. Let us see what they are as we move on to such mandated dues. The first would be to evaluate the non-audit services very closely and ensure that independence is not impaired. Given the extremely wide canvas of management services which is being given by NFRA in the reports, close monitoring of such non-audit services need to be evaluated, and conflicting situations should be avoided. Yet another mandated due would be to obtain audit committee's pre-approval together with detailed notings to be kept in audit file. In fact, in one of the reports, NFRA has clearly mentioned that there was no detailed discussion at the audit committee level regarding the provision of non-audit services. Neither was an approval taken nor a discussion was in place. So the last thing that probably the practitioners could be doing would be to closely monitor any possible self-review threat so as to avoid any observation by NFRA. This is with respect to independence. Such a detailed evaluation and such a detailed work would also help us maintain. If you go back to the earlier slide that we mentioned, and probably it's worth going into the first file. I'm just going back to the initial observations on the independence of mind. We'll probably recapitulate it for the sake of a reminder to all of us. An independence of mind, independence in appearance, and it would be worth our cost to go through this definition once again. Independence of mind, a state of mind that permits the provision of opinion without being affected by any influence that compromise our professional judgment and our skepticism. Independence in appearance is where we avoid circumstances that a reasonable third party would believe that the team and the partner's integrity and objectivity and skepticism has been compromised. So I think that's something that I thought we should go back and look at it. Similarly, management services will be, just if you recall this broad canvas, the key things that for us to note would be services that essentially constitute management responsibilities. So the question to put forward to us to avoid the self-review threat would it be a service that essentially constitute management responsibility? So with this, I'll move on to the next slide and probably the next, that's what the mandated dues. That's the first slide on the mandated dues. On going concern related matters, it would be good. The mandated due would be to prepare detailed work papers, inter alia, including each and every indicator, going concern indicator, how they've been addressed, what are the audit procedures which has been done to ensure that such indicators have been addressed appropriately, and whether whether the management is right in using the going concern assumption in preparation of financial statements. Evaluating the same and challenging the management assumption with an independent view, and ideally the such detailed analysis should also be cleared with those charged with governance. One of the reports very clearly, as has been covered in the earlier slides, where we have mentioned that there is no detailed GC discussion with those charged with governance. So that would help the cause of the practitioners as far as going concern matters are concerned. The projected cash flow statement and other forward-looking assumptions based on which the accounts have been prepared, the financial statements have been prepared on going concern assumption, should be backed by sufficient, appropriate audit evidence, like strong order book, third-party evidences, board-ratified plans, what are currently under action, what is going to be done, what are the timelines committed, and how the board and those charged with governance are monitoring the same. In respect of team planning event, such team planning event should have detailed agenda, including the participation of the engagement partner and the engagement quality review partner, should have carry forward points from the previous years. What is the experience of the audit team? What is the experience of the engagement team? What are those carry forward points which will have implication for current year audit? The presumptive fraud risk related to revenue. What are those significant components of the balance sheet and the P&L, and the preliminary analytical review analysis, and what are those significant audit procedures that should be done by the engagement team to ensure that risk of material misstatement is brought down to a manageable level, and what is the audit firm's response to such risk of material misstatement. Similarly, team planning event should be done on an ongoing basis during the course of the audit, starting from, in case of listed companies, starting from quarterly reviews. Updated team planning events should be done on an ongoing basis for every quarter, including during the course of the final audit, to factor in new developments. Such new developments could be in areas of technology, anything which could impact the company, like a regulatory action, sudden developments on the markets, significant loss of customer, emergence of a new competitor because of the new age technology, etc. All could be new developments which could have a bearing on a company's financial statements, which should be factored by the engagement team, and team planning events should be done by them on an ongoing basis to factor such developments. Similarly, there should be independent assessment of the management experts' work, including assessment of their quality, including assessment of their credentials, the work done by them, the relevance of the work done by them with respect to the audit, and our reliance on the same, and how we are factoring that audit process and procedures should be adequately documented and should form detailed part of our work papers. So also goes the same with legal experts' opinion, and such a legal expert's opinion should be an appropriate document with respect to reliance placed on the same, assumptions given in such legal opinions which are independently vetted, which, as you observed in the earlier comments, NEFRA clearly has mentioned that there was no detailed assessment of the legal experts' assumptions and numbers which are given by them in the legal opinion. Similarly, with respect to NFRA observations on ECL, on the expected credit loss models, such ECL models should be analyzed and assumptions of the management should be challenged and duly backed and supported by independent documents, which entirely includes new credit ratings, factors which are favorable to the company, which need to be backed by sufficient appropriate audit evidence by way of third-party evidences like customer confirmations, better cash flows, etc. And the same should be corroborated and filed by the audit team in the work papers. Similarly, if any reversal of ECL provision should be, they should also be viewed as a potential fraud risk, and how the audit team and engagement team is corroborating the same with the external evidences available should also be filed by the team in their audit work papers. With respect to the last point, loans related parties, the same should be evaluated with respect to repayment capabilities, an independent assessment of various projects which are currently undertaken by such related parties, what is the fairness with respect to terms and conditions, and how it is impacting the financial statements of the company, etc. And other judgmental aspects should be documented in the audit work papers file. So these are the mandatory dues with respect to these matters. Similarly, with respect to complex transactions like derecognition of borrowings, the same should be supported with updated confirmations in the audit work papers file, clearly indicating the revocation of the any other confirmation which is available in the audit work papers file to conclude the appropriateness of such derecognition of borrowings, including supporting the accounting entry of the same, and if necessary, a robust legal opinion should be taken before causing necessary accounting entries. This all, whatever I'm stating here is as given elaborately in the standard, though not explicitly, but at least in terms of the professional skepticism and judgment. These are the expectations as given in the standards of auditing issued by our Institute of Chartered Accountants. Similarly, in respect of CARO, detailed work papers for every class, along with samples selected and tested, what are the work papers and samples, including independent papers, and the conclusions with respect to the CARO point, and the assertive, and if it is a positive affirmation, how we are concluding on the same should be appropriately documented. Similarly, in respect of ICFR, the same should be backed by an RCM, key controls, non-key controls, samples selected for testing, how the same is being analyzed, and whether the controls are effective or not, and then conclusions drawn should be very clearly given in the work papers. This probably clearly establishes the linkage. One of the key observations given by NFRA in their audit quality review reports entirely includes the fact that there is no linkage between the audit planning, the team planning event, and the work papers and the conclusion summary and those charged with governance. So here, the linkage has to be established between the planning document, the updated team planning events, the new developments which have come in, the response of the audit firms to such new developments, how the work papers are factoring in on all significant components, and how the work papers are addressing the risk of material misstatement, procedures which are addressing the same, minuting the critical discussions with the company management and with those charged with governance, and the follow-up action arising out of the same, including the audit conclusion summary, by whatever name it is called, and how each of the points which are originating from the team planning event and updating work papers are finally concluding at the audit conclusion summary, and how the critical points are being presented to those charged with governance. These include significant matters related to going concern, significant matters related to any fraud which have been detected in the company, significant matters involving management estimates which have been independently corroborated, any independent estimate as given by the management expert, any work, any conclusion based on independent legal opinion. All these things could ideally form part of communication, those charged with governance. And similarly, the subsequent events to be appropriately documented as adjusting and non-adjusting event, and appropriately dealt with the audit report. So I think these are the mandated dues which are given as per the essays issued by our institute. Moving on to the next slide, what are the definitions which are to be carefully monitored? One would be the EOM para, and the other would be a qualified opinion. In respect to EOM, it is a para which is included in the audit report, which is already presented in the financial statements, but it is of such importance that it is fundamental users' understanding of the financial statements. Ideally, an EOM para is given in respect of matters where there's agreement between the practitioner and the management of the company, and such matters are of significance that it will be helpful to the user to appreciate the financial statements in a better context. Such matters would include legal opinions, backed judgments and conclusions which are arrived at by the management and also agreed to by the practitioner. And such legal opinions should always, could ideally be updated legal opinions closer to the date of the signing of the audit report and closer to the date of the financial statements. Similarly, an EOM, as mentioned in the standards on auditing, is never a substitute for a qualified opinion. And the pervasive use of EOM is actively discouraged by this standard. It says that extensive use of EOM may dilute the weightage of the report and may not give the full information required to the users of the financial statement, is as elucidated and as given in the standards of auditing issued by our institute. The next definition will be on the qualified opinion part. Here the auditor shall express a qualified opinion when the auditor, having obtained a sufficient audit evidence, concludes that the misstatements are material but not pervasive to the financial statements, and the auditor is unable to obtain sufficient appropriate audit evidence, but the auditor concludes that the possible effects of undetected if misstatements could be material but not pervasive. So in a very brief manner, one can say that when there's active disagreement between the management and the practitioner on certain matters, those could warrant a qualification audit report. And such a qualification, if replaced by an EOM, can never be a perfect substitute, which is also given in the standard. I have not added adverse opinion, but if it is just in the context to give adverse opinion, it would be nothing but sufficient appropriate audit evidence, which, if the auditor has obtained such sufficient appropriate audit evidence, and the misstatements individually or aggregate are both material and pervasive, then it could lead to adverse opinion in the financial statements. But in my limited experience, I've seen more qualified opinions than adverse opinions. So I've not brought adverse opinion more as a matter of for ease of reference than anything else. And there's one more thing which is not there in the slide, which I thought I should highlight to the audience here. And that would be, very high level observations which are given by NFRA on the financial reporting quality review, which has been conducted on a company for a financial year 1920. And that is on the management side. That is, I want to just take 3-4 minutes to give a very high level summary of what NFRA has given on this financial reporting quality review, to give you a perspective to the audience who are attending this webinar. Just to give the high level one, they say that some of the NFRA conclusions, recommendations of such observations are given into two categories. One is high and moderate, and I will probably briefly touch upon, although not given in the slides, certain high level, certain high impact recommendations, which include policy for forex contracts is erroneous, and non-compliance with classification measurement requirements of India is 109. The outstanding amounts are not given. Hedge accounting has been followed but not mentioned in the policy. The policy with respect to material element of financial statement, that is revenue, is erroneously stated in the statement of significant accounting policies. Based on the company's response, it is observed by NFRA that the actual recognition and measurement principles applied for accounting of revenue is different from what is stated in the audited financial statements in respect of important aspects of R&M of revenue, which impacts the amount of and timing of revenue recognition by the company. Similarly, in respect of impairment of financial assets, trade receivables which are having negligible credit risk and those backed by bank letter of credit have been based on the historical past experiences and not based on the forecasted conditions. Similarly, another last observation they made, which I'm just highlighting, would be on the disclosure requirements as per with respect to provisions and contingencies. And these are actually given in the financial review reporting report. So with this, I think I genuinely thought that we should cover the significant aspects and leave it at that. And I leave. I am happy to take any questions. Happy to address any clarifications our friends may have. Yeah.
Yes, sir. We have a few questions from our participants.
Yes.
Sir, is the screen visible to you, or should I just speak out the question for you so that you can answer?
Screen is not visible, but I can, speak out. No problem. You can ask the questions.
Okay. So one of our participants, that is Karan Chopra ji, has asked a question that what is the difference between EOM and other matters and key audit matters?
Yeah, key audit matters is, where you believe that these have a significant, I'm giving a contextual definition, not the exact definition. The key audit matters are those where auditor believes that these balances and significant components must be highlighted to the users. He also mentions the audit procedures which are done and how they have responded to such key matters, and the procedures done by them is given in a very elaborate manner in the audit report. And this is applicable to certain class of companies as given in the standard. Other matters are those which are which have nothing to do with the financial statements, more of information. Like, ideally, if you are the incoming auditor, you probably say that, previous year figures have been audited by another auditor. So those are this thing. Emphasis of matter is only on matters where there's an active agreement between you and between the audit practitioner and the company. and generally given in respect of matters where there's a significant financial number sitting in the financial statement, which is based on an opinion or an estimate or involving complex judgment, which is also backed by a detailed note in the financial statements, which the auditor in his professional judgment believes should be highlighted to the users. Yeah. I hope that,
that question is answered. But in case if you have any other query, then you can kindly raise the question again. Yeah. So our next participant, that is Mr. Vinay KS, has asked what kind of investment actions should mid-tier firms make or take to ensure audit quality?
Come again, madam. What sort of investments?
So the question is, what kind of investments or actions should mid-tier firms make to ensure audit quality?
Okay, excellent question. I think simply following exclusive one would be a great start for mid-tier firms. Number one. Number two, active involvement of the partners from start to finish of the audit, particularly complex engagements, would be necessary. Number three, a well-trained staff is a great asset to any professional firm. So the only investment should be a knowledge and repeated training sessions on various aspects of auditing standards, on every single accounting standard, including audit procedures to be performed by the engagement team on every single component. And such trainings repeatedly being done would enhance the quality of staff and thereby mitigate the risk of the mid-tier firms. Yeah. And last but not the least, the documentation standards as elucidated by our institute in the various auditing standards should be complied with, and that the proof of pudding lies in the eating. And I think an independent review and an independent reviewer should come to the same conclusions as what the practitioners has come would be the biggest test, and such efforts should be made to enhance the documentation rigor and the procedures by such firms. I think these are the broad indicators and investments that the firms should do to ensure that audit quality is always maintained at the highest level as expected by the regulators, the institute, and the other stakeholders.
Thank you very much, sir. So hope, Vinay, your question is answered, but in case it remains like you have any other query, then you can raise the question again. Our next participant, Nanjunday Udeshemaji, has asked, in case of joint auditors, who will have the full responsibility?
Very, I would say, nebulous question, but I would tend to think that each person is responsible for his portion of the work. But ideally, each person is responsible for his portion of the work. But definitely, I think the expectation from everybody would be that there is a moral joint responsibility. Yeah.
So again, there's a question from Karan Chopra ji that audit firms are required to undergo quality review by QRB. How it is different from work done by NFRA?
NFRA is independent regulatory authority by the government. The QRB is by the institute. So the people who are coming will be totally different. In respect of QRB, what I understand from the process, it is undertaken by the various members who could come from other firms who are coming to do a quality control check of the audit firm. And to that extent, they are totally different from NFRA, where such people who are coming are experts who are appointed by the NFRA. Yeah.
Thank you, sir. Next participant, Shashi Kanji, has asked a question that NFRA has suggested an annual report from audit firms and an expert external body for audit review. How do small and medium firms get impacted by this?
I would profess not to answer this question because I'm very clear that I'm not going to give any opinion for or against. I think we will have to wait for some clear directions to be given by our institute also, and we'll wait for such directions to come.
Okay, sir. Thank you very much for the prompt response. Our last question is from Aditya Janji, that which all services can be rendered by statutory auditor?
I think I want us to give a very objective answer to it. I think some tax and tax-related services are being given by various firms. I would put it that if there is a I think the best way to answer the question is for the practitioner himself, by asking him one question to himself. Is there a self-review threat? Am I going to audit anything that I'm giving opinion on? Am I going to audit anything that I'm going to review or comment on? And I think that way one would be serving his cause very well to ensure that such self-review, conflicting situations and threats are avoided. So I think that would be the correct way of answering this question. Yeah.
Thank you very much, sir. So, with this, we end up our question answer session. But I would like to request all of our participants. So, once again, like in case any of their question has remained unanswered, or if they have any other further questions, then our eminent speaker is available. Kindly raise the same so that you can get your answer at the moment itself. Okay, no such questions. So, sir, would you like to share some message for our participants regarding the session?
I think I have no special remarks to make, excepting that this session was only about the key observations given by NFRA in their various reports.
Okay.
And I think I've been able to scan and read through all the reports so far they've issued at a very detailed level, and the observations are coming from them. And the mandated dues is something that I attempted to do to ensure that the observations going forward would come down to a significant extent. And I have no specific message for the practice. I'm sure they are completely aware of the requirements which are imposed by the regulators, the institute, the stakeholders on us. And I'm very confident that each and every one of us will continue to respond to such as confidence which is reposed on us.
Thank you very much, sir, for providing such of your valuable time for contributing to this session. Like Texman family really appreciate your efforts for the same. I hope all of the participants get detailed guidance over the same, and very huge thanks to all of our participants for making these sessions quite interactive and contributing your time as well for attending this session. So, guys, in case you have any other queries, then you can directly email to us, or you can coordinate with us over our number so that we can make you coordinate with our speaker directly. And for more of such videos on updates and webinars, stay tuned with us and wait for more of such updates. So, sir, thank you very much for your time. We really appreciate your efforts. Thank you.
Thank you so much.
So, with this, we will conclude this session here itself. Thank you, guys. Thanks a lot.